Fidelity just charged investors $100 to buy an ETF, and nobody's talking about it. YouTube long-form script, min read /1, 501 800 words. Hook 0, 00030. Fidelity just quietly added a $100 fee to over 120 ETFs. Not $4.95, not a small percentage. A flat $100 charged every single time you hit buy. And here's the part that should make you angry. They're not charging the ETF companies. They're charging you asterisk. Today I'm breaking down exactly what happened, which funds are affected, and what you need to do right now if you hold any of these in your Fidelity account. Intro/title card 03100. Music/B-roll of Fidelity app, trading screen. Welcome back. If you're new here, I cover personal finance, portfolio strategy, and the stuff that Wall Street doesn't exactly advertise. Hit subscribe if you want to stay ahead of moves like this one. Let's get into it. Section 1. What Fidelity actually did 1-00300. Here's the timeline. Back on March 16, 2026, Fidelity sent a letter to a group of ETF issuers. The message was short and not sweet. Pay us a direct, asset-based fee to keep your funds on our platform, or we're going to charge your investors $100 every time they buy a share. That's it, that's the whole story. Some issuers said fine, they negotiated deals, paid the fee, and their funds stayed commission-free. But a lot of the smaller, newer issuers, the ones who couldn't afford to play ball, refused. And starting June 1, 2026, their investors are the ones footing the bill. Now here's the context you need. This isn't coming out of nowhere. ETF trading has been marketed as free for years, zero commissions, no transaction fees, just buy and hold. But that was never actually true. What was really happening is that large ETF issuers, Vanguard, BlackRock, State Street, they've been quietly paying Fidelity and other platforms a revenue-sharing fee to keep their funds accessible and commission-free. It's called a distribution arrangement. Think of it like a grocery store charging brands for shelf space. You don't see the fee, but it's baked into the system. Big issuers have the scale to absorb it. They have billions in assets, they have marketing budgets, they write that check. Smaller issuers, the new thematic funds, the covered call ETFs, the niche income strategies, they can't always afford it. And up until now, Fidelity looked the other way, not anymore. The original fee list had about 27 funds, mostly tiny, obscure names that most retail investors had never heard of. LifeX Longevity Funds, Twin Oak, Aslan, nobody was losing sleep over it, but the new list. Over 120 ETFs. And this time the names are ones you actually know. Section 2, who's on the list 3-00530. Let me walk you through the biggest players. Roundhill Investments is the most impacted issuer on the entire list. Over 40 of their ETFs now carry the $100 fee. That includes. And here's what makes this genuinely absurd. MAGS currently trades around $66 a share. The fee to buy it is $100. That means if you're buying a single share, the commission is more than the stock itself. Even if you're dropping $5,000 into MAGS, that $100 fee is a 2% upfront cost. That's before you've earned a single dollar of return. 2% gone on day one. Curve Asterisk is the other big name. They have about 12 funds on the list, all of their yield premium strategy ETFs. These are the ones tied to single stocks like Apple, Tesla, and Google, popular with income investors, now stuck with the fee. Beyond those two, there's a long tail of smaller thematic issuers, crypto-adjacent funds, levered single-stock products, sector plays. Meb Faber, the founder of Cambria Investments, posted about this on X and called Fidelity, and I'm quoting directly, cretins. His post racked up over 260,000 views in a single day. That tells you how much heat this is generating in the industry. Fidelity's official account actually responded publicly. Their defense. This isn't technically a commission because it only applies to purchases, not sales. I'll let you decide how convincing that is. Section 3, the pay-to-play problem 53730. Let's talk about what this actually is because the language matters. Fidelity is framing this as a service fee, a cost to cover the operational expenses of maintaining these funds on the platform. But what it really is a toll booth. You either pay the platform to keep your fund accessible or the platform makes your fund toxic for investors to buy. That's a pay-to-play model. And it creates a real problem for competition and innovation in the ETF market. Think about it this way. If you're a small ETF issuer, a two-person shop with a genuinely interesting fund strategy, how do you grow? You need distribution. You need your fund to be available where retail investors actually are. And right now, Fidelity is one of the biggest platforms in the country. If you can't afford the revenue-sharing arrangement, your investors get punished. And if your investors get punished, they leave. And if they leave, your fund dies. So the message to new issuers is clear. Innovate if you want, but you better have deep pockets or a big enough fund to buy your way onto the shelf. Now, to be fair, and I want to be fair here, Fidelity hasn't kicked these funds off the platform entirely. They're still accessible. And the defenders of this policy will point out that most ETF trades at Fidelity are still completely commission-free. We're talking about a narrow slice of the market, but here's my problem with that argument. It's a narrow slice asterisk today asterisk. The list just grew from 27 funds to 120 plus. What does it look like in 2 years? Where's the line? And more importantly, the investors buying MAGS and Chat and the Curve Income ETFs aren't hedge funds. These are retail investors, often on the smaller end, buying a few shares at a time. A $100 fee on a $200 purchase isn't a service fee. It's a wall. Section 4. What you should do right now, 7/30/9/30. Okay, enough about the problem. Let's talk about what you actually do. Step 1. Check your holdings. Fidelity has a live service fee list published on their website. I'll link it in the description. Go look at what you own. If any of your ETFs are on that list, you need to know before your next buy order. The fee only applies to asterisk purchases, not sales. So if you already hold MAGS or Chat or any of the Curve funds, you can still sell them without paying the $100. But the next time you try to add shares, it's there. Step 2. Check the order preview screen. This is your last line of defense. Every time you place an ETF buy order on Fidelity, look at the order confirmation screen before you hit submit. Fidelity is required to disclose the service fee there. It's not hidden, but it's easy to miss if you're moving fast. Slow down and read the screen. A $100 surprise is a bad way to start a trade. Step 3. Consider where you buy. Here's the thing, you don't have to buy everything on Fidelity. Schwab, Robinhood, and Vanguard are not applying this fee to the same funds. If you want to keep adding to MAGS or one of the Curve ETFs, nothing stops you from opening a separate account at another broker for those specific purchases. It's a little inconvenient, but it's a lot better than paying $100 a trade. Step 4. Reassess the funds themselves. And I know this sounds harsh, but if an ETF is so niche that it can't afford to maintain distribution on the biggest retail brokerage platform in the US, that's information worth having about the fund. I'm not saying sell everything on the list. Some of these are legitimate strategies, but it's worth asking whether the fund you're holding has the institutional backing to stick around long-term. Revenue-sharing fights like this tend to shake out the smaller players over time. Section 5. The bigger picture 9/30/11/00. Zoom out for a second. The story the industry told retail investors for the past decade was this. Commissions are gone. ETF investing is free. The little guy finally caught a break, and that was mostly true as long as you were buying the big brand name funds that could subsidize the arrangement. What Fidelity just did is pull back the curtain. Every free trade has always had a cost. You just didn't see it because the fund company was paying it. Now that the bill is being passed to investors directly, people are upset, but the mechanism was always there. The question worth asking isn't, why is Fidelity doing this? The answer is obvious, they want revenue. The question is, will other platforms follow? Keep an eye on Schwab. Keep an eye on Robinhood. If Fidelity makes this work without a mass exodus of accounts, there's a real possibility this becomes industry standard. If that happens, the era of truly free ETF investing narrows significantly, at least for anything outside the Vanguard iShares SPDR core. Outro 11/00/12/00. Here's the bottom line. If you hold mainstream ETFs, VOO, SCHD, QQQ, VTI, anything from Vanguard, iShares, Fidelity's own funds, you're not affected. This is not a crisis for the average buy-and-hold investor. But if you've been building a position in Roundhill, Curve, or any of the niche thematic issuers on that list, June 1st is your deadline. Know what you own, know where you're buying, and don't get hit with a surprise fee you didn't budget for. Check the link in the description for the full list of affected ETFs directly from Fidelity's site. If you found this helpful, drop a like. It genuinely helps the channel. And if you want more breakdowns like this, subscribe and hit the bell. I'll see you in the next one. End card/subscribe animation. Description box copy *. Fidelity is charging a $100 fee on 120 plus ETFs starting June 1, 2026. Here's everything you need to know: which funds are affected, why it's happening, and what to do before you place your next buy order. Link Fidelity Service Fee ETF list, https://www. Fidelity. Trading Commission's margin rates. Pushpin chapters. 000 hook. 030 intro. 100 what Fidelity actually did. 300 who's on the list. 530 the pay-to-play problem. 730 what you should do right now. 930 the bigger picture. 1100 outro. Chapters/timestamps included above.